Thank you all for joining wherever you are in the world. I know we've got a bit of an international audience tonight, so thank you for taking the time to join. This is the first of a series of webinars that we're going to be doing throughout the year. Obviously, being January, this is number one, and we're going to do them at the end of every month. And we thought it would be good to start with a guide to investing in UK property in 2024. There's obviously a lot going on in the market from various different angles, and I think it's good to see where we are at the moment at the start of the year, when a lot of you want to make your investment decisions and set yourself up for the remaining 12 months. So I'm going to start and just give you a little bit of an overview about Joseph Mews. My name is Johnny Conran, and I'm a managing partner of the company. And you're going to hear from myself first, as I say, giving you a bit of an introduction into who we are, for those of you that don't know us. And then you're going to hear from Liam Smith, who is a partner at Knight Frank, and he's going to give us an introduction to UK property investment and how to set your goals. We're then going to hear from Sophia Kazmi, who is director at the Madewell Group, and she's going to talk to us about financing, about your options, wherever you are in the world, whether you're a British expat or British citizen or not, how and what your options look like for mortgages in 2024 and where Sophia sees the market going. Then phase three, it's going to be this or that, the choices that you have in UK property, of which obviously there's many. And that's going to be my other partner, Andrew Siegel, who's going to talk to us about that. And then last but not least, we're going to hear about choosing the right location, which, as we know, when it comes to property investment is incredibly important. And we'll choose and show you why we've chosen certain locations in the country over the course of the next 12 months. So we'll get started. Can I have the next slide, please? And the next one. So as I mentioned, a little bit of an intro into Joseph Mews. The company was actually started a long time ago by the gentleman you see on your screen now, Andy Foote. He is our director and our chairman of the business. And he started the business, or a distribution business, I should say, for property investment back in 2001 after his own experience of investing in property. He had a pretty bad customer service experience having bought an off-plan property. There was no communication. There was no hand-holding through the process of mortgages and furniture and renting the property. And he thought, surely it can be better than this. And having been a successful business owner previously, he decided to take on that role. And so it's a pretty impressive resume so far. £854 million is what he achieved with Seven Capital, working specifically with one developer. But only 2 years ago, we rebranded as Joseph Mews to give ourselves more options, to give ourselves more developers, more locations, more price points within the country to offer people like yourself and our investors around the world. So we often get asked why we're called Joseph Mews, and I think this explains it pretty well. The photo of Andy that you can see there, you'll see the sign that says Joseph Mews. That's one of our offices in the UK, and it's a Mews house called Joseph Mews. Why is it Joseph? Well, you'll also see the brain tumor charity logo on your screen there. Now, Andy, as I say, has owned various businesses, but he'll tell you his greatest success is starting the brain tumor charity, which many of you may recognize the logo. It is actually the biggest in the world, the largest brain tumor charity in the world. And Andy started that after his son, Joseph, passed away from a brain tumor at age 9. So it was named after him, and various houses and offices and places that he owns around the world are named in Joseph's memory. And this being Andy's swan song as a business, we wanted to name the company after him and one of our offices there. So that's where the name comes from. And if we go to the next slide, please. Obviously, as a business, we endeavor to raise as much money as we can for the charity and such an amazing cause that Andy founded. So if you do ever obviously want more information, then it's on our website and you'll get more info shortly. Next slide, please. So to give some context of Joseph Mews and what we've done as a business. So we've sold just under 3,500 units so far. That's just under £600 million worth, 34 different developments that we've marketed and sold. And obviously the 28% repeat purchase is a big thing for us. So our clients are all over the planet. I know on this call, we've probably got 4 different continents. We've got people all over the place that we've dealt with for years, from our Seven Capital days all the way, obviously, through to now. So our job is really to help facilitate that investment wherever you are in the world into the UK. And I guess the important part of this slide is to show that we've done it many times before, and we've got clients all over the world that have tried and obviously succeeded in achieving what they've set out to achieve. Next slide, please. So when I mentioned rebranding as Joseph Mews, the main sort of idea behind that was the fact that we wanted to work with specific developers that we knew we could trust, developers with a track record, with the right funding in place, with high standards in terms of what they're delivering, but also obviously with the best locations where we foresee obviously the market progressing at a more positive rate than anywhere else. So some of the names on the screen won't mean a lot to you. They're all proven developers that we've worked with that are fantastic, that deliver fantastic property around the UK. Knight Frank at the top. Obviously, we've got Liam, the partner at Knight Frank, speaking with us tonight. Knight Frank are partners of ours, which is obviously incredible for us as a business to have such a big name behind us. And they introduce us to developers that use Joseph Mews exclusively on occasion to distribute their property. So it goes without saying that obviously whenever we are affiliated with a company of the likes of Knight Frank, obviously the due diligence goes to the nth degree. So it's a great partnership for us to have, and it sets the standard. We don't want to deal with anybody. We use our experience and Andy's wealth of experience to be able to know who we should work with and who we shouldn't, which particularly when you're overseas and you feel a bit removed from the whole process, it's really important. Next slide, please. Again, whether you're in the UK or you are overseas, the process of buying a property can be pretty stressful. And anyone that tells you that it's not has probably never bought a property before, because there's a lot to go through. The UK is strict on its AML processes, as it should be, and the legality side and the mortgages and everything you need to consider. It is complicated and there's a lot to do. Is it worth it? Absolutely. We've seen how the UK property has performed as an asset class. And, obviously we're going to hear more about that, but there's ways of making it more straightforward, particularly obviously if you're overseas, where you're a little bit, especially if you're not a British expat or British citizen, or you've not spent time in the UK, it can feel quite daunting. So one thing that we've set up very well as a business through our experience, as I said, from Andy starting it on a customer service level, is having your hand held through the process. Introductions to lawyers, introductions to mortgage brokers, to the agents on the ground, who's going to rent my property. We facilitate all of that. And you're always dealing with Joseph Mews. You're not being passed over and just goodbye and good luck. We deal with you from the moment you reserve until 10 years in the future. You always deal with us. So we're always going to be a point of contact. And that's the point that we want to achieve with our clients. And the reason that we're doing these webinar sessions is not to sell a property. It's to guide clients as to how to build portfolios and to structure those in the right way and diversify existing portfolios. So every single step, as I said, you're going to have someone from Joseph Mews guiding you through post-completion as well. Next slide, please. So I'm going to give you a case study, and this is incredibly relevant because it literally just happened. We just handed this development over. It's right in the center of Birmingham, on the canals. As you can see in that photo, it's called Lockside Wharf. It's a beautiful development with Consortia, who are one of the developers you saw on the screen. We work exclusively with Consortia. There's the only way that you can invest in their properties is through Joseph Mews. And they built this stunning development on the canals, 61 apartments only, 1, 2, and 3 beds, and it just handed over now. So we go to the next slide, please. When we were handing this over, or just before we handed it over, we sold it out way ahead of completion. And in the UK Property Awards in 23, this actually won 3 first place awards. So it won the best architecture of a multiple residence in the whole of the UK for the year. Obviously in the West Midlands, it also won and the best residential development 20 plus in the West Midlands as well. So it shows you the standard and the quality of what we want to deliver. We don't just want to deliver carbon copy apartments. We want things that are going to stand the test of time, where you're going to have an exit strategy and are going to perform better in the market than the generic new builds that you might see. So this is a great example. You can see on the photos here, I mean, it was above and beyond even what the CGI showed. The quality's been fantastic, really is an amazing development, and all the buyers are obviously incredibly happy with what they've achieved, and obviously renting out very easily given where it is and what it is. So we go to the next slide, please. You'll see we've had all 5-star reviews for this development, which is obviously great feedback. We sold this 18 months off plan, which is, again, daunting. A lot of these buyers had never bought off plan before. A lot of them were overseas, hadn't been to Birmingham. So, to be able to fly over and see the apartments for themselves and what they had put their money into 18 months before and how it's performed for them and how it's performing now is great to be able to see. So, again, testament to the developers that we work with. Next slide, please. So believe that we're going to do a couple of polls quickly, but one thing to mention, which I forgot to mention at the beginning, is if you do have any questions throughout the presentation, there is a Q&A box at the bottom. So you just click on that and then they'll be sent through to us. And then at the end, we'll answer as many as we can. So yeah, feel free to ask anything that you want to ask. Right. So the first poll question, let's hope this works, if technology doesn't fail us. But it should come up on your screen and you're going to have the options. And it's good for us to understand what your primary objective for investing in UK property is for 2024. So I believe there's 6 options there. So if you wouldn't mind clicking one, it would be great to see what the majority says. So I'll give you a few seconds to do that. Okay. I'm not sure how we close this. There we go. So here we go. So establishing a passive income stream, number 1, and then building a property portfolio. Yeah, makes sense. Number 2, the passive income stream is, having done this for 10 years, is the biggest, I guess, criteria that I see wanting to be filled from investors is being able to build something for the future, passive income stream. And that's, I guess, yeah, makes sense that it would be the number 1 here because it's what we see most. Skip forward one more slide, please. What's your biggest fear when it comes to investing in UK property in 2024? So same again. The question should be coming up. Okay, can we go forward from that? Right, I'm not sure that one works in particular, but hey, we got 50%. That'll do. I'm now going to pass you over to Liam Smith, who's a partner at Knight Frank. And as mentioned, he's going to run us through an introduction to UK property investment and how to set your goals. So I'll pass you over to Liam now.
Thanks, Johnny. Okay, so my name's Liam Smith, partner at Knight Frank, and Joseph Mews have asked me to give you a bit of an overview on the UK property market and what our forecasts are for 2024, and also just answer some brief questions that have been thrown at me. So we can just go to the first slide, please. Okay, so this is a question that I'm asked on a daily basis, and I'm sure all the guys at Joseph Mews are as well. So international buyers are obviously considering different investment classes, whether it be stocks, shares, property, other countries in the world to invest in as well. So why should you invest in the UK? Well, there's obviously a lot of reasons, and there was lots of different locations within the UK itself to invest, but I think the overview and the main reason for investing in the UK in residential property is the sustainability and the fact that it's a very robust property market. Now, I'll come on to why it's so robust shortly, but if we just have a look at the graph on this particular slide. So property prices since 1977, which is roughly when Land Registry started recording, or at least made them public. As you can see, there's been a steady growth over that period of time. So in the 70s and the 80s, property prices were doubling every 5 to 6 years. In the 90s, it sort of took 13, 14 years, and likewise throughout sort of 2001 to 2015. So it's becoming slightly longer to have a double of price growth. But since 2015, certainly till I would say sort of the turn of the decade, so 2030, 2031, 2032, we are expected to see another double of price growth. As you can see on the screen there is the odd correction or a blip, but it is never too detrimental. The biggest dip in the market was the global crash, so the recession in 2007, 2008, 2009. But as you can see, it quickly recovered. So anybody considering the UK should be entering the market with confidence that if you're in it for mid to long term, your property shouldn't depreciate and you should gain value in the property that you're investing in. Now, the reason for that and what is underpinning the price growth is supply and demand. We're a small nation, an island with a growing population, rising immigration, we're living longer, and we've got a fairly ambitious housing target, which we are consistently not delivering. So there is an undersupply of new build property built year on year on year. And there's lots and lots of reasons for that. Build costs, build inflation costs, the fact that planning restrictions are so heavy in the UK, that actually is a good thing for anyone investing. It just means that there's going to be a sustainable undersupply of property, which is driving that market. So next slide, please. Okay, so I mentioned that the UK property market is very robust. So the reason why I'm showing you this slide is because anybody with any sort of uncertainty or any worries or fears about obviously entering the UK as a property market should look back on the last 5 years. And there's been some fairly monumental sort of things that have happened that could have had a huge impact in terms of negative impact on the property market in the UK should it have not been so robust. So let's go back to the EU referendum. So should we leave Europe? Then we had Brexit. Back then, I was getting people asking questions, oh, what does Brexit mean to the property market? You know, what does the referendum mean? It just means there's a bit of uncertainty, but I was very, very confident that prices wouldn't dip, and I was right. We then went into another general election, more political uncertainty, same questions. What does a general election mean to the market? It means there's a bit of uncertainty, but the market still went in one way. Then we had the global pandemic, and no one knew what was going to happen come the end of that once we came into normalization. But what we did see is a surge in property transactions, and we have a pro-property government in the UK, which is another very good reason to invest here. So if something like the pandemic was to arise, as soon as the lockdown restrictions in the UK were lifted, there was obviously a backlog of transactions, but the UK government, to boost the construction industry, to boost the housing market, and to boost the economy, decided to provide a lucrative stamp duty holiday, which in a sense meant that the market increased by 15% the year after. Now, anybody that was considering investing during the pandemic would never have thought that actually the year after the UK property market would rise by 15%. On this graph here, you can see that in 2012 was the last time we had any average price decrease in the UK. Every other year since then has been in a positive. So can you just go to the next slide? Okay, so the most important part of a property investment is obviously the tenant itself, if you're a residential property investor. So the amount of high quality apartments in regional cities up and down the country, there isn't enough of them. And there are more and more professionals moving into city centres in the UK because this is the new modern way of living, being close to bars, restaurants, where they work, so their offices. And there's not enough of these apartments being built in city centres. And there is roughly, we're being told by letting agents up and down the land, there's about 25 tenants wanting to view every high quality apartment. So anybody that's got any fears of potentially having an empty property or void periods, you shouldn't have those fears because the market, the rental market is so strong in the UK. As long as you're buying in the right location that does have a genuine undersupply and not an oversupply of new property coming through the pipeline, which obviously Joseph Mews will look at and bring the highest quality developments in those areas to you, you are going to be fine. Birmingham is one of Knight Frank's primary markets in the UK outside of London. And last year, rental asking prices went up by 14%. And that is something that is going to continue to go. So the rental market is very, very, very positive, and it will just continue to grow more and more over the next few years. Next slide. Okay, so where's the property market heading? Well, if I'm going to be really honest, 2023 was a challenging market. We're up against certain factors, mainly in the mortgage market. So Bank of England base rate was increasing steadily throughout the whole of the year. So when we had the mini budget back in November 2022, interest rates for mortgage lending and the base rate just went up and up and up and up. Now, what did that mean? It meant that pretty much half of the market, or half of the buyers that were going to buy in 2023 didn't. So would that mean that the market was in a negative price? No. The average price in the UK last year plateaued. So there was no decrease, but there was no rise either. So even in what I would consider to be one of the most challenging markets I've ever had, property prices didn't decrease. Now, so far this year, we've seen some confidence sort of overspill from last year. So I think it's back in October was the first time that Bank of England base rate didn't increase. It's stabilised. It hasn't started to go down yet, but it does look like inflation levels are curbed and are starting to slowly come down, which in tune should mean that the Bank of England base rate will start to fall this year. And I'm sure the mortgage expert on this webinar will give us some more insight on that. So we've actually revised our predictions for 2024. We were going to be quite cautious and say that we're going to probably see similar sort of market trends in 2023. There could be some areas that go up by a percentage or two, but the average would be about sort of even. Well, we've now changed that, and we believe that the market will increase on average by 4.7% in 2024. Nationwide reported this morning that prices in the UK on average have risen by 0.7% in January alone. We're 31 days into the year. So that is showing that there are more buyers back into the market. There's more confident buyer sentiment is there, and there's certainly a lot of overseas buy-to-let investors now buying again in the UK. Now, we're in a bit of a race for mortgage rates at the minute. We have lenders in the UK up until the end of the financial year, the next couple of months, cutting their mortgage rates under the base rates. I think we've got 5-year fixed rates for local buyers in the market under 4%. And that's really boosting the market. So everybody that couldn't afford to buy last year because of mortgage interest rates or affordability issues are now back into the market. And we've got a bit more of an overspill of sales coming in, similar to what happened after COVID with the lockdown restrictions, then a surge of transactions. We're seeing that now. If the base rate drops, then that is just going to continue to go. So we look back on past growth and what's happened historically since 1977, we're just going back on that upward trend. And we believe that 25 and 26, there will be continued and sustainable house growth of around 5% year on year. Birmingham has seen 5% price growth prior to 2023 for the previous 3 years before that as well. So the market is looking pretty good. And if you are looking at investing in the UK, please take into all this account. And I'm sure we've got many, many more questions. So you can reach out to the guys at Joseph Mews to have a consultation on that. But I think that's all my slides. Could go to the next slide. Yeah, thank you.
Thank you very much, Liam. So I'm just going to jump into talking about the mortgage market really and your opportunities for yourselves as overseas investors. So my name is Sifia and I'm the director of Madewell Group. We're an international mortgage brokerage headquartered in Dubai. And we assist clients predominantly based outside of the UK, but looking at investing in the UK, whether that be for the first time or whether you're looking at potentially building your property portfolio. We offer a bespoke mortgage offering to all of our clients. I think that's really important to highlight in the current market that we're experiencing at the moment, particularly for those international clients who perhaps have slightly more complex income structures or profiles, we offer a bespoke offering with a range of over 700 different types of lending institutions. So we work with private banks, high street banks, the likes of Halifax or Barclays or Nationwide, which many of you may have heard of, but also a range of private banks, private equity firms and funds across the UK, Europe, and the Middle East and Asia as well. So dependent on your circumstances and what you're looking for, and ultimately what your goal is, we will find that lending solution to tailor those needs and meet your requirements. In terms of the mortgage journey, just to run through this sort of process and how it works once you are introduced to Madewell Group, we will initially carry out our introductory call, which is a 30-minute call just to ascertain what you're looking for and what your goals are. We will go into some details with regards to the different types of mortgage options available, which I'll touch on a little bit later on. And then from there, we will go away and research those mortgage options for you. We will then revert with what we call a mortgage illustration or an indicative term sheet, which essentially illustrates the mortgage that we recommend to you. That will then highlight what the mortgage is going to look like, how it's going to be structured, so the loan amount, the interest rate, and ultimately what your monthly repayments are going to look like, which you can then plug into the cash flow that Joseph Mews give to you for the property in question. And that will then give you a clearer picture as to how that investment is going to work for you and overall what the cash flow looks like. Then typically if you are buying a property which is off plan, so perhaps not complete yet, but completing a little bit later down the line, we will then pick up on our conversations closer to completion. So we normally advise about 4 months prior to that property being handed over. At that point, we will pick up on our conversations perhaps that we had a year in advance, just to ensure that nothing has changed, but also with the mortgage market changing constantly and with interest rates constantly changing and going down, which is what we've seen significantly over the last few weeks, as Liam touched on, we will review those options again and come back to you with the most competitive illustration at the time. At that point, we will start collating all of the documents that we need for your mortgage. So dependent on your income structure, whether you're employed or self-employed, we'll collate all of that documentation together and we'll package it and send it off to that bank. The underwriters will then review the application. Once it's approved, they will instruct a valuation on the property. And then once the valuation has been carried out, you will then be issued with your binding mortgage offer. And that is a binding contract from the lender, which is typically valid for a period of up to 4 months. And then that enables you to complete on the property. So at that point, your solicitors will then be working on completion simultaneous with the developer's solicitors to set a completion date. Go to the next slide, please. And just to touch on some of the more commonly asked questions for clients globally, one of the main questions we get asked quite often is, can I get a mortgage for a UK property purchase? And the answer simply is yes, and that is, well, of course, our bread and butter. But more importantly, you don't have to be based in the UK. You don't have to visit the UK. You don't need to have a footprint in the UK to arrange the mortgage. A lot of our clients are first-time buyers and perhaps don't travel to the UK throughout the whole mortgage process, even post-completion. Or everything can be done remotely through your solicitors and through us, who can certify documentation and manage everything from overseas as well. We will work closely with all of the parties involved, so the lender, the solicitors, the valuers, and all other parties, tax advisors if need be, and so on, to manage that whole process from application all the way through to completion. So whether you have a footprint in the UK or perhaps you are a first-time buyer, you don't need to be present in the UK, and you can certainly have access to a mortgage. How do I become mortgage ready? So as I mentioned, I think we will have that initial introductory call to ascertain what your mortgage options will look like. It's important to have that conversation to ascertain how it's going to look from a cash flow perspective. And then closer to the property completing, we'll pick up on those conversations. It's also important to have those conversations because dependent on perhaps your income structure. So perhaps if you're retired, or if you don't have a fixed income, or if you're predominantly commission based, we can sit down and look at what documents you need to start preparing. So if it is that perhaps you're buying a property which is completing in 12 months' time, you have that period where you can start working and preparing all of those documents ahead of when we need to submit the application. So that's, I think, the earlier you can start working on those documentation, the better. What costs are involved with buying through a mortgage? Again, it depends on your individual circumstances. It's important to highlight that it varies dependent on whether you are the lender we're going to, how bespoke the offering is. Typically, the fees to bear in mind are lender fees. Those can range anywhere. Some lenders don't charge a fee and they'll just charge a valuation fee. Some lenders will charge a flat fee. I would say on average, if you budget for in the region of around a 1% to 1.5% lender arrangement fee. It's important to note as well that is normally only due on either successful completion or when you have something binding from the lender. The only fee that may normally be due upfront is the valuation fee. And I normally say that will be in the region of around 0.1% of the purchase price. So if you're buying a property for £300,000, you can estimate that valuation is going to be in the region of around £300 to £350. How many options do I have? Well, as I said, we work with a range of different lending institutions, over 700 different types of lenders. When we have our initial conversation, we will then be able to narrow it down to who is going to be the most competitive lender. We will often come back to you with a couple of different options, and then we will sit down together, review those, and we will decide together on who you want to proceed with. But often there are a handful, there is more than one option that we can go to, and sometimes, depending on how complicated the mortgage is, we often will run a plan B in place as well, just so if in the event that plan A doesn't work out, we do have a fallback mortgage option in place. And yes, point 5, although not a question, speak to a mortgage broker. Certainly, I think the earlier you can sit down and have that conversation with us and see what your mortgage options are, the smoother the process is going to be later on. I think one of the other questions that came up on the poll earlier was also what are your concerns for investing in 2024, some of the major concerns. And I think the most popular answer was interest rates and predictions for 2024, which is a conversation we're having a lot at the moment, and quite a positive one, certainly since the beginning of the year, because we've seen interest rates come down significantly over the last 4 weeks, I'd say, since the beginning of the year. A lot of lenders who price themselves into the market quite highly over the last 2 years have reduced their rates quite a bit, and in order to remain competitive are doing so and constantly reviewing. And international borrowers can get up to 75, sometimes even 80% loan to value. So that means you would need to put a deposit of 20 or 25%, and the bank will finance the remainder. And I think we're going to see interest rates continue to come down over the next 2 years, particularly. The base rate is predicted to go down to 4% by the end of this year. So a lot of borrowers particularly are looking at either fixing a rate for 2 years to have that security that your monthly payments are going to remain the same for the next 2 years, or if you're happy to go for a tracker rate, that's also quite a popular option, because that's a rate that mirrors the Bank of England base rate. So as and when that goes down, that rate will be reflective of that. Can go to the next slide, please. Okay. Just going into further detail, I suppose, with regards to the UK mortgage market. So inflation was recently recorded at 4%, which is significant, and it has dropped, and consistently it is coming down. I think back in 2021, it was recorded at 2022. Sorry, it was recorded at the highest level of 11%. The Bank of England have, as a result, to try and combat inflation, they have increased the Bank of England base rate, which is why we have seen it had gone up consecutively for 14 months. It had peaked at 5.25, and the predictions are that it is going to start to come down March, potentially the next review, with a view that it might come down to 4% by the end of the year. Lenders, as a result, as I mentioned, are competing against one another to ensure that they do remain competitive. Particularly, interest rates are based on swap rates in the market. So as those fluctuate, lenders are starting to reduce their rates, both on fixed rates and tracker rate mortgages, so variable rate mortgages as well. If we can move on to the next slide, please. And just going into a bit more detail with regards to the other costs involved when purchasing a property in the UK. So of course, as I mentioned, you have a deposit. So when you purchase a property, the bank will finance, let's say, up to 75% of the value. You need to, as the purchaser, put down a deposit. The other things to bear in mind are stamp duty, which a tax advisor will can advise on in some further detail. That does depend on your circumstances, so where you're based, how many properties you own, the purpose of the property. But it is worth speaking to a tax advisor, and also looking at the last point with regards to tax on rent received, because there are ways in which you could potentially look at reducing your liability and structuring, especially if you are looking at perhaps growing a portfolio of properties, and your goal over the future is to become a portfolio landlord. It is certainly worth looking at doing that and structuring it in an efficient way. Conveyancing fees, so that's the legal fees that you pay, which is a one-off. Lender fees, as we touched on. Brokerage fees, which are bespoke depending on your circumstances, whether you're remortgaging or purchasing. Letting agent fees, landlord insurance, property maintenance as well. And finally, gas check safety, which I think Joseph Mews probably touch on in a bit more detail as well. Next slide, please. I think one question we get asked quite frequently is, what are the benefits, or what's the difference between purchasing in cash versus purchasing with a mortgage? And in order to do so, I'm going to just go through an example, but prior to doing so, I'm going to just touch on interest-only mortgages. So you can go to the next slide. So this is quite a common concept in the UK and in the US and some markets in Europe, but overall it's not very common globally, and it is quite a rare offering. But an interest-only mortgage is a mortgage which enables you to pay back just the interest portion of the loan amount every month, as opposed to a capital repayment mortgage, which is a conventional mortgage, if you were, where you're paying back the loan amount and the interest every month. So this means on a monthly basis, your monthly payments are going to be significantly lower than they would be on a capital repayment basis, which ultimately increases your cash flow. So interest-only mortgages, as a result, tend to be the favourable route if this is a buy-to-let investment, and if you are looking at growing a portfolio, because as opposed to tying up all your equity and putting it into one asset, just enables you to diversify and spread that across multiple assets and become a portfolio landlord, should you wish to do so. There are potentially, and again, it's worth speaking to a tax advisor, but again, an interest-only mortgage sometimes can reduce tax liabilities, potentially inheritance tax and so on. So that's another reason why it's particularly popular, and again, why an advisor might suggest sometimes to structure it in that way. But it leads on nicely to my next point, which is how you can then grow a portfolio. If we then go on to the next slide, please. So this example just demonstrates the difference between purchasing a property in cash versus purchasing it with a mortgage. And we're going to use the same property value here, just to compare. So the first example is based on a purchase price of £200,000 for one property. So assuming you purchase a property all in cash for £200,000 and you hold on to it for 10 years, you then sell it 10 years later for £300,000. Your investment 10 years prior was £200,000. However, you've made a profit now of £100,000, which equates to a 50% profit. Now, using that same property, you could have potentially obtained a mortgage. So you put down a £50,000 deposit and you borrow the remaining £150,000 from the bank. Again, you hold on to that property and sell it in 10 years' time for £300,000. Your profit is still £100,000. Your investment, however, was £50,000. So as a percentage, that is a 200% profit. And where you really see the benefit is then when you look at spreading that over multiple assets. So if we just go on to the next slide, that £200,000 that you would have put into the first example, into one property, you could look to spread that over 4 different properties, totaling a combined asset value of £800,000. So 4 properties each at £200,000. Your loan amount will then be £600,000. So over 10 years, you then sold each of those properties again for £300,000 each. Now, your investment was still £200,000, as it was in the first example. Your profit as a result is £400,000, but then you can see that as a percentage, that's a 200% profit. And that's where you see the benefit of leveraging and take advantage of borrowing or maximizing the loan amount from the lender, and combining that with an interest-only mortgage just ensures that you can maximize and really take advantage of leveraging as much as you can. Just jump onto the next slide. And I'm going to pass on to the team just to talk about points to consider in investing into the UK market. Thank you.
Thanks for that, Sophia. Good insight there into the mortgage market, and whether you're overseas, expat, national, local, or UK, of course, we can support you for any mortgage requirements there. So on to phase 3 of the webinar. We've entitled this or that. So we're looking at sort of key considerations really for successful UK property investment. And what I've got here aren't, there's no particular sort of rights or wrongs, but with a little thought, research, a bit of work, help, advice, you can really maximize your investment in terms of getting the best capital appreciation and rental yields. At the end of the day, as we saw from the slides, it's all about the maths. It's all about making money. We want to buy the cheapest property. We want the best capital appreciation, and we want the highest rental yields, all common sense stuff. And as I say, with a bit of research and a good partner, and you can do that. If I can have the next slide, please. So one thing we always get asked is houses or apartments. We speak to thousands of investors. Some people are adamant they only want a house. Some people say they want an apartment. If you look back historically, when you looked at Liam's figures, and that applies to all types of houses, apartments, etc. Some people, and I think a lot of people just buy with their heart, not with their head. So I would always say, if you think you want a house, keep your mind open. Have a look at the maths, do a bit of research. Apartments may work a lot better for you. You would argue back in the day, houses were better for capital appreciation, but less rental yields than apartments, and apartments maybe less capital appreciation, but better rental yields. However, post-COVID, I think as Liam mentioned, we've seen that change quite dramatically. We've seen people want to be closer to work, want closer to amenities in the city centre for the lifestyle. They want an apartment because it's cheaper to buy, cheaper to rent, it's cheaper from a utilities point of view as well. So again, it's good to look at so they aren't really cons on any of them, but have a look at budget. And of course, with apartments, you haven't really got any houses in the city centre. With apartments, it's that city centre living, which post-COVID, we're back into the city centre now, again, just to keep those the prices down. People don't want to necessarily be out in the countryside with a house. Some people have put off apartments because of ground rent and service charges. And as you may know, ground rent has been scrapped. So the government's done something really good there. So there used to be a ground rent charge. That's now zero, or it might be a peppercorn, so it could be £1 a year. And again, it really makes the apartment sort of virtual freeholds, and you've got a lease length of minimum 250 to sort of 1,000 years. If your great grandchildren need to extend that lease, again, the rules and regs are changing this. So it's very easy, hundreds of years down the line, to extend that lease. So that's why we say it's like a virtual freehold, because it's as good as. Service charge is something to look at. It's important to look what the detail of the service charge is. They're normally expressed in sort of pounds per square foot. So if you've got a 500 square foot apartment, it's £2 a square foot. It's going to cost you £1,000 a year. The service charge, I always say, covers everything sort of outside of the front door of your apartment to the perimeter of the development. So in 40, 50, 60 years' times, if it needs a new roof, new whatever it happens to be, you haven't got to put your hand in your pocket because you're building up that fund over a period. Something else that impacts as well, of course, is the facilities. Everyone wants lots of facilities on board. But again, just as an example, to have a 24-hour concierge, we all want 365 days a year on the front door. That costs on average £160,000. That's got to be divided across the number of apartments, which is great if you've got an apartment block with 10,000 people in it. But if it's a smaller apartment block, then again, we advise, as Johnny mentioned earlier, we work very closely with developers and we advise on pricing and all these facilities and services. So it's just getting that balance right. Because in the city centre, you're only around the corner for a gym and all these facilities anyway, and that can keep the service charge down, and that will obviously impact your net returns. Also on the service charge, any increases need to be justified. Prices can't just go up without justification. And again, with a new build, you've got a 10-year warranty. You've got new lifts, new windows, new roofs. So again, things are a little bit different nowadays when you look at service charge against a new build. Next slide, please. So we're looking at off-plan investment already made. We've sold and we sell both. One of the benefits with off-plan is you're getting in early. You're getting a bigger choice of apartments. As Johnny mentioned, Lockside Wharf, which we delivered, we sold out 8, 9, 10 months before completion. And normally, depending on the developer, if you're getting at phase 1 pricing, as the build progresses, the price goes up. So off plan, literally buying off the plan, off from the brochure, and choosing an apartment. But again, with help and support from a good promoter or a good developer like us, it's a pretty straightforward process to help pick the right unit. You're getting the choice, and you are, whilst you're not getting a rental yield, because an off plan could be up to anything up to an 18-month or more build. But as we saw from the capital appreciation point of view, the deposit you put down is working from a capital appreciation point of view. So your money is working for you. And other people we see maybe like something closer to completion or something that's ready now. And other people like what we call a ready-made investment. So it's maybe newly completed, furnished and tenanted. So you're buying today and you've got a tenant in there ready to go. And again, buying off plan means you've got the latest specification, the build warranties, you've got the latest energy efficient apartments. And as I mentioned earlier, when we looked at the facilities, you've got amenities, things like residence lounges, communal gardens, gyms, wellness centres, that kind of thing. And with off plan, you're typically, not always, but you're typically putting down 20% up front, and then 80% at completion. And then as you've seen in the UK and for overseas clients, the bulk of that 80% can be mortgaged. Next slide, please. So we've got long-term lets and short-term lets. I suppose most of us are familiar with a long-term let, where you'd have your house or your apartment, you work with a local letting agent, you'd sign up your tenant for a 6 or 12-month period. It could be on a rolling contract or maybe renewable. Everyone knows where they are and you've got a fixed monthly rent coming in, so you know exactly what your gross, or more importantly, exactly what your net returns are going to be. Some are becoming more popular now as the short-term lets. They offer higher returns. So I suppose a short-term let would be serviced accommodation. So something like the Airbnb model. And that could be someone coming in for as little as 2 days. So there's quite a few factors to be taken into account if you're going down that route. First of all, make sure the developer allows it in the lease. Running costs and management costs can be 10, maybe 15% higher. Who cares when the net returns can be double? So again, you need to look at the full story. So you need to look at void periods, and we have cash flow summaries, and you can go into a lot of detail where the short-term lets are allowed. And we work with a corporate short-term let partner, so it's not the Airbnb style leisure client, it's corporates. So again, that's easier to predict. But again, quite popular. And we're very, as a promoter, we represent the developer as well as our investor clients. So we want to protect the integrity of the development. So we've worked hard to get short-term letting partners where appropriate. As I say, there's lots of health and safety and insurance to be taken into account, but we manage it. As you've seen, we offer a fully managed service. So it's an armchair investment. If there's more work to do, more fees, but it can be a lot more profitable. If I could have the next slide, please. So something we get asked, maybe more so for particularly from overseas investors, is should I invest in London or the regional cities? I'm going to talk a little bit about the some areas in the UK to invest in. We did a webinar in December talking about going into more detail on locations, and that's available on our YouTube channel. Anyone wants to go back and look a little bit more detail into the particular areas. But I think it's important to know that 70% of investors that are living in London aren't investing in London. They're investing in the regional cities, predominantly further north, where guess what? Capital appreciation and rental yields. You're getting more value, you're getting a lower price point, you're getting higher rental yields, and as I say, the capital appreciation is predicted to be a lot higher in the regional cities. But I'll come on to some figures for different regions in terms of capital appreciation yields as well. Okay, if I can have the next slide, please. Okay, so choosing the right location for your UK property investment. Let's have the next slide. So we've got connectivity. We've talked quite a lot about, obviously, mortgages, but there's quite a lot of research you can do. We've looked at the supply and demand dynamics, so you could almost say, well, I'll go anywhere. But and there are areas that will outperform other areas. So as an investor, we don't really mind where the area is. We just want to make the maths work. So we look for areas of good connectivity. Where is it located in the country? How accessible is it to other parts of the country? Because you can have that sort of local market, and then you've got the further afield commuter market. Liam was mentioned Birmingham earlier on, and Birmingham's the #1 area for people leaving London and relocating. So it's the #1 location is Birmingham. There's already 171 trains a day that go from Birmingham New Street to London, and of course we'll have the icing on the cake, which will be the HS2, the new high-speed 2 train terminal, which will cut journey times down from Birmingham to London to 49 minutes. If people are familiar with London, look at what the Elizabeth line did, these massive infrastructure projects. That's a new railway line, about 20 billion, that runs all across from the west to east of London to Reading to Canary Wharf. So again, these huge infrastructure projects have big impact on those local areas. And then it's always important to look at the regeneration, future developments, universities, job markets, rental demand. There's a city that we're working in, 16 billion of investment going in at the moment, part of a massive big city plan. So apart from all the supply and dynamics and the shortage, you've got all these companies relocating there as well. So again, a little bit of homework. We've got a lot of resource available online. You can do your own research and see for yourselves what's happening. I think one thing to note as well, you've got these BTR schemes, build to rent schemes. So they're institutions, banks, pension funds, even companies like John Lewis and Marks and Spencer's. They're getting into the renting market. They're building whole blocks. They're never going to sell the apartments. They're renting them. Why are they doing that? Because they know that the market is strong and it's going to give a good return to their investors. A couple of people have asked, will the market be overcrowded with these institutions coming in? No. We should be building, I think as Liam mentioned earlier on, in terms of numbers, we should be building 320,000 new homes a year. We've never made 200,000 for decades. And even if we did build the number we need, it's 50 years before that supply and demand dynamic balances out. There's something on the news the other day, by 2036, we're saying that the population in the UK is going to grow by another 6 million people to 74 million. So we've got the housing shortage. So really, it's the perfect storm. I'm old, and I've never known the market to be as strong as it is for the landlord, particularly in terms of that supply and demand dynamic. So again, lots going on in key areas, but HSBC are leaving Canary Wharf. Half their business has already left. They're looking at moving the other half of the business. And you've got the likes of your Goldman Sachs, your PricewaterhouseCoopers relocating to these northern areas as well. So exciting times. Can I have the next slide, please? Thank you very much. So we looked at different investment areas and top areas, and you can see there we've got Birmingham, Derby, average property price, average rental yields. That would be for a normal AST, so that would be for a normal sort of short-term let, potentially more, as we said, on the net yields with the short-term lets. And as Liam was alluding to or mentioning earlier on, good, strong 5-year price predictions, and the same with the rental capital appreciations. And again, we'll look at a couple of these sort of hotspots in terms of what's happening in these areas, but there's ever such a lot going on in these areas from a regeneration point of view. So again, it's the icing on the cake. Next slide, please. We talked about London, and yeah, if you've got a couple of million, I can understand why you'd want to invest there. It's what I would call maybe a trophy asset or a trophy investment. But as you can see, the average property price is over £600,000, and the rental yield and the capital appreciation is predicted to be less. So you can do more with your money coming out to the regions. Next slide, please. Again, what we're showing here is we want to get the cheapest apartment or house in the best location with the best capital appreciation and the best rental yields. So again, if you look at your Manchesters, your Birminghams, the ones that we've listed, and the ones where possible, we try to work in. We do develop in other areas as well. Your Manchester, your Birmingham, your Derbys, your Leeds, they are your top areas in terms of capital appreciation and the rental yield prediction. I'll have the next slide, please. Thank you. Birmingham, I'm just going to cover my last 3 slides. I'm just going to look at 3 of the areas that we saw in the previous slide. Birmingham is the second biggest city in the UK. It's number 2 in terms of numbers behind London. Strongest business economy outside London, population, very young market, 60% of the rental market are aged under 35 years old. So we've got longer term tenants there. You've got areas like Arena Central, Paradise Circus. There's 18-19 new office blocks that have been built. Final ones are being finished off this year. HSBC moved in a couple of years ago. Brindley Place with 12,000 people working there. Where British Telecom are, you've got 4,000 people working there. That's Snow Hill Wharf, and that was the largest speculative commercial development outside of London. So again, you come to the city, you'll see thousands of cranes, not a lot on the residential. It's all commercial with the Goldman Sachs, and as I say, these are corporate HQs. So Birmingham holds the second most pop concerts in the world. You've got more Michelin star restaurants outside of London than anywhere else. You've got the largest library, largest cultural space, football teams, massive industry, financial, tech, retail, clothing, and of course, you've got the high-speed train. So that will really be the icing on the cake. Yes, like we mentioned with the Elizabeth line, it was set for 56 billion. Of course, it's going to be over budget. Of course, it's going to be late, but construction is well underway. The terminal is going into the south of the city in Birmingham. There are other projects as well. Smithfield Market's another £1.5 billion project. All part of this £16 billion regeneration scheme and part of a big framework and a big plan called the Big City Plan, which is running now from 2016 to 2040. So the skyline is changing dramatically in Birmingham. Next slide, please. Manchester, again, similar to Birmingham in terms of property price, rental yields, good growth prediction there. And Manchester City Council has plans to become net zero carbon, zero waste, and zero climate by 2038. And again, you've got areas like factory, so new cultural landmark with studios and music venue. Piccadilly Gardens is an open space in the city centre with leisure opportunities and has already become a destination point in the city. Trafford Regeneration Master Plan, more green areas, more housing. You've got the new Salford City Stadium and Salford Quays, which most people might know. It's a 550 million investment, and that's where the BBC have relocated to out of London. ITV Studios, Warner Brothers. You've got 250 businesses associated with that media business in the area as well. So again, ever such a lot going on. Crazy. And the next slide, please. So we've got Derby, again, nice low price point, similar rate, rental yields, capital appreciation, got all the fundamentals we're looking for there. You've got good employers there. You've got Bombardier, who build trains. Rolls-Royce are the aeroplane engine manufacturer. Toyota, they're building cars. Of course, you've got a lot of associated businesses around that. You've got 3.5 billion of inward investment. We've got the universities. That's the highest university graduate sales pay in the UK. 46% of people that leave the university end up staying in Derby. Very well connected city in the middle of the UK. Just 37 minutes to Birmingham, 86 minutes to London. So again, all the fundamentals that we're looking for. And importantly, just to give you an idea of the size, I think we always judge these things by your shopping mall. It's 200 shops in the shopping mall. It's the 15th largest in the UK. So that probably gives a good idea of the sort of the size and the demographic. So I think that's me. I think we're going to hand over to Johnny now, who's going to look at a couple of developments, Q&A, and a few other bits and bobs, and we'll be around to answer questions at the end. Thank you.
Thanks, guys. Yeah, and I'm aware we're over an hour now, so don't want to keep you for too much longer. But the last thing that we're going to do is just go through a little bit of the investment opportunities that we've got at the moment. There's various of them, and we're only going to touch on a couple of them just so you have an idea of what we're building and what we're offering our investors. So if we go to the next slide, please. So number one, and this is one that we are doing with Knight Frank. This is right in the centre of Birmingham. We've built a lot there over the years. We know the city super well for all the reasons that Andrew just spoke about. But this is as good as it gets. It's right in the city centre, 150 metres from the CBD, where all the jobs are, 150 metres from St Paul's Square, which is the most beautiful part of the city centre. Great developer called Henry Boots, who are well-renowned, award-winning, and they're building this beautiful structure that is just over 100 units. It's going to have a yoga studio. It's got a roof terrace that you can actually see in the photo there. It's a private garden. It's going to have a co-working space. It's going to have a cafe downstairs. It's got everything really in the best location in the second city of the UK. So we're really excited by that. You can see there, and the CGI is what it's going to offer on the ground, and then the yoga studio. And, you know, we live in a new world now where people are working from home a bit more and they care more about what their apartment offers rather than just being four walls and a bed. So this is really on point, on trend. You've got the Knight Frank and the Henry Boot, two incredible partners to be working with on this. So we're really excited by that, and it completes very soon in Q3 of this year. So yeah. These, I believe, are real photos of the showroom there. So yeah, fantastic development. Next one. Next, we've got one in Manchester. So this is complete slightly further away. So you're looking at completion in 2025. Again, as Andrew mentioned earlier, most developments are 20% deposit. This is also 20% deposit, but you can split it because it's further away from completion. You can put 10% down now, then you put 10% down in 6 months' time, and then you don't pay anything else until it completes in 2025. So from a cash flow perspective, you know, at the entry level here, you're looking at 20-odd thousand pounds initially, 20-odd thousand pounds in 6 months, and then the remainder not until 2025. So makes it more manageable cash flow wise. And again, Manchester, great investment location for all the reasons that Andrew said. Next one, please. Again, these are some of the CGIs. This too has its own private gardens, communal areas as well. And again, look, everything we build is towards the professional tenant. That's our target market. We want to go for the more sophisticated tenant that's going to treat the property better. That's why we don't ever build student accommodation or what you would class as first-time renters accommodation. You need an exit strategy, and you need something that's going to stand the test of time. And the best way to do that is build quality in quality areas. So that's our focus. Next one. Dalton House. Now this is in Derby. Slightly lower price point, 185,000. This is complete. It's a beautiful development. We sold a lot of this in different blocks. They're all rented. They've all rented very straightforwardly. It's one of the largest regeneration sites in the whole of the UK. So you've got it was an old grade listed building that you can see in the photo there. It was Florence Nightingale that actually designed this area back at the end of the 19th century, and they've turned those grade listed buildings, one's into a restaurant, cafe, and co-working space. Another one, if you go to the next slide, another one's into a gym and spa rooms at the top. So again, it's got the amenities. It's a beautiful development, and this is complete now, or completing now, I should say. So again, you've got three different options there. You've got something that's complete now. You've got something that's completing in 5-6 months, and then you've got something that's completing in 18 months' time. Again, if you go to the next slide, that is everything. We do have various other properties, but I think for the sake of time today, we're just going to show you those three. And obviously it goes without saying, if you do want to book in a free consultation, then obviously just let us know. And you have myself, Andrew, and Mark from Joseph Mews. Obviously, if you do have any questions on a mortgage perspective, which people often do, it's often the first conversation, then Sophia, we've worked with for years. She's done hundreds of mortgages for our clients all over the world. Book in a meeting with her, and you can understand what your options are there. To give you some context, over 90% of our investors take mortgages, and they're based all around the world. So you will have options. It's just understanding what they are, typically up to 75, sometimes 80%. But they'll range from anywhere from 65 upwards. So once you understand that, you can understand your affordability, and then you can look at the right options. But as I say, I'm in charge of the Middle East in particular. Mark's down in South Africa, Andrew's in the UK and Europe. So wherever you are in the world, book in a consultation, and we'll be happy to go over everything, anything and everything. I think we do have some questions. We've had some that have been sent in, and I'm going to call upon some of the other speakers. So just to answer a few of them. And again, look, we're obviously going to send everything over to you, recording of the webinar. Any questions, you will have our details to ask, and whether you want to book in a consultation or you just want to ask a couple of questions, then obviously feel free to ask. One of them, which I think, Liam, is for you, is about 2023. Why was 2023 a challenging year? And the prices still didn't drop. I think you touched on it in your slides, but it'd be good to go over that again.
Yeah, thanks, Johnny. So the challenges in the market were the fact that obviously the base rate was steadily going up and up and up, and buyers' affordabilities were getting stretched. But also a lot of buyers were a little bit uncertain as to where that base rate would ever end up. So certainly a lot of people buying with plan were a little bit sort of curious as to what would the rates be like, when they complete the project. So it's out of people's control, but I think it was all to do with affordability and certainty in the market. In terms of why property prices haven't declined, again, it's to do with transaction levels. So whilst there was half of the amount of buyers that bought in the market last year, the amount of transactions was still pretty high in comparison to other markets globally. The UK property market, transaction-wise, is very, very vast. One of the things that helps the market considerably was that there was a lot of cash buyers in the market that were actually sort of underpinning that market. So felt that there was a bit of an opportunity to get a bit of a head start over people that potentially were buying with mortgages. So there's just a lot of confidence in the UK market in general, and locally. The sentiment is that, that there is very rarely an opportunity where you'll buy a property and the next year or the year after the property prices have gone down by 10%. If anything ever drops, it's usually by 1 or 2%, and then very, very quick to recover, and we're back on the upward trend again. So hopefully that answers the question, but it's all relative to Bank of England base rate.
Appreciate that, Liam. And I'm going to keep you for 1 second because I know that you're good with this question, which has obviously been asked a lot, particularly to you being based in Birmingham, which is regards to we've got a question about Birmingham and Nottingham City Councils going bankrupt, obviously. Are you still positive, bearing in mind that they've gone bankrupt? So it'd be good to hear your thoughts on that.
Yeah, they haven't actually gone bankrupt. So councils can't go bankrupt. So there's a government over that basically it doesn't allow them to go into bankruptcy, but it is in layman's terms, a term of bankruptcy. So basically, the government has stepped in and brought in independent facilities to basically run these councils. In Birmingham, I'm not too sure about Nottingham, but I would say it's exactly the same. It doesn't change day-to-day life. So street lights haven't gone off because they can't afford to pay the street lights. Bin collection hasn't stopped or anything like that. So everything that you would expect in terms of normal council day-to-day operations is exactly the same. And we also need to take into consideration they haven't got to a point where they're short of money because of any overspending when it comes to maybe the Commonwealth Games or HS2 or the Midland Metro or the regeneration. None of this has actually contributed to them being in this position. It's actually to do with something called an equal rights payment claim, which has been going on for decades. And the basically out of court settlement has in effect made them bankrupt. And it's happened in Nottingham, and it's going to happen to every council pretty much in the UK. That doesn't have any bearing on the property prices themselves. We still have an undersupply of property. What will happen in Birmingham, we've already seen it, is they are actually selling some of their assets. So the airport, for example, going to an independent or a private investor, which is great because they're going to invest in the airport. And a lot of the land that Birmingham City Council owns, so their assets, they're actually unlocking and offering out to developers to actually build new commercial premises, food and beverage, mixed-use developments, and residential. So it's actually going to push the market slightly because there's going to be more development opportunity. So we haven't seen anything that would suggest it affects the property market, and I would say that would be the same for every city across the land.
Awesome. Yeah, thanks, Liam. As you say, the fundamentals of it don't change. The undersupply, the need for property, the jobs, all of that has happened, and the day-to-day doesn't change for the consumer or the tenant, as it were. So, yeah, thanks for that, Liam. Just reading through a couple more. Will we be sent the slides? Yeah, as I mentioned, everyone will be sent the slides after the presentation. We've got a question here about, wouldn't it be good to know, shouldn't you consider the interest rate you paid if you go with a mortgage when calculating the rate of return? Yeah, absolutely. It's a good question, and it's something that we create cash flows for every single unit within every development based on what the rental yield should be in that area. So we always get a rental appraisal from an agent on the ground to say, right, this is what we could rent this apartment for today. So we then obviously equate the yield versus the price of the property. Now, once we have that, obviously every single development and every unit has a different cost to it. If there's a service charge, obviously that's based on a price per square foot. So for a 1 bed, it's going to be different to a 2 bed. We accumulate all of these costs into a cash flow and project them over a 15-year period. And you'll see relative to your exact situation. So if you have a call with Sophia and she tells you, right, your mortgage is going to be 70%, your interest rate is going to be 5.5%. This is what the options are going to be for a 25-year period. We will plug all of that into the cash flow relevant to that unit, relevant to that development, and then you'll be able to see exactly what your cash flow looks like. So it's a good question, and it is important to understand what your mortgage rates and your mortgage offerings are, because the reason that we are building or part of developments and offering developments in Birmingham and Manchester and Derby and not central London is because that process and that possibility is there, because the rental yield is high enough that your tenant can pay off your mortgage. When your yield is 6%, that is possible. When you're buying in central London and your yield is 2%, that's not possible. So it is really important, and it's why, as I said, that we choose these locations to offer as investments, because the whole beauty of buying in the UK is that you can buy a property, you only have to put, let's say, 30% of your own equity in, and that 70% is being paid off by somebody else's money, and that's the person renting your property. So So yeah, so that's a good question. And as I say, if you want these cash flows and to go through them, then I suggest booking in a consultation, and we can send those over. One more, I think, Andrew, this was one for you. The Labour government want to place limits / taxes on international buyers. What effect might that have on the market?
I don't think it'll have much effect at all. We never used to have stamp duty. We've now got stamp duty. We never used to have taxes, as there are some taxes now for overseas buyers. I haven't read anything about placing limits, but let's say it happens. So, because of as long as you've got the money to afford to pay those taxes and to invest, it's not going to affect the market. The market is strong. Yes, we probably have, as a company, probably 35%, 40% of our investors are overseas, but the market is still strong. We're struggling to get really good quality new developments. When we're pricing up developments for developers, the build costs have gone up 20-25%. So that is going to have a huge impact on new stock coming through if developers do want to carry on building. So I don't think it will have, yes, if you can't afford it, if you haven't got the tax money and don't want to do that, but unfortunately there are taxes and there are ways of structuring. A lot of people now are buying in limited companies, which is probably a subject for another day, and that can help with certain taxation in terms of sort of capital gains and things like that. So honestly, with the supply shortage, the population growing, I don't think it'll impact on pricing at all, or the day-to-day market.
Perfect. Thanks, Andrew. We've got a question that I think is quite good to sort of generically, particularly for my clients that are based overseas, is to do with, do we have a good recommendation for a solicitor to deal with a British expat living in Qatar or Dubai, as an example? Look, as we said before, we've got 3,500 clients around the world. Yeah, Far East, Middle East, Africa, Europe, UK. And so through practice and through our history, we've obviously had to accommodate that process and make it as smooth as we possibly can. So things, buying a property as a British expat living in Dubai is an example that I can speak of, having done myself, is different to buying if I'm living in the UK, obviously. And having a lawyer that understands that, having a lawyer that understands the implications of me living in Dubai, having a mortgage broker that understands the fact that I don't earn the pound and that that I'm an overseas resident. These things make your life a lot easier, having people that have done it before. So that is something that we do wherever you are in the world. I think our databases, we've pretty much covered every part, I think, over time. So you're going to be in good hands and dealing with people that have dealt with every region really before. So yeah, so to answer that question, we've got plenty of opportunity to introduce you to.
Just saw a question as well from Melissa. Hi, Melissa. What fee do we pay to purchase property through Joseph Mews? We don't charge any fees. There'll be things like obviously stamp duty, solicitors' fees, furnishings. We can help with all that. So there's additional costs, if you like, but no fees. We're remunerated. We partner up with the developer. So nothing to pay us out of your pocket there.
Yeah, I think it's a good point, and a good question that we commit to the costing of the developments in ways because we pay for all the distribution, the marketing, everything on that side. So we're very much committed to each development that we work in. We don't just work as an agent that sells a property. We partner with the developers and we commit ourselves. So I guess it's called hurt money that we commit from our side. So it shows our commitment and our belief in the developments themselves. Got another question here about the rentals. How do we accommodate renting when we're living overseas? Again, I think touched on it before, but everywhere that we build, whether it's Manchester, Birmingham, Derby, one of the first things that we do is understand who's going to rent the property. Because look, Birmingham, we've built hundreds, thousands of units there, so we know the market very well and we know who the best agents are. But it goes without saying that the tenant is the cornerstone of your property investment. Without rentals, without somebody renting the property, the model that I just talked about doesn't work. So we take that very seriously, and the first thing that we do when we take a development on is speak to the agents on the ground. A, to understand what the demand is. Will there be demand for this? B, to understand what the rental yield will be. How much will you be able to rent it for? and to be able to obviously facilitate the process. So as an example, with the Settle development in Birmingham, that's coming up to complete relatively soon. And when just before that completes, we'll build a showroom, or the developer will build a showroom, and then we'll be able to show potential tenants around. So having bought one myself, the way that it worked for me is that the showroom was created 3 months before completion, and the tenant moved in the day that I completed because he was already lined up beforehand. So we accommodate that whole process. You obviously have full discretion over who you take as a renter. You'll get a call from the agent to say, hi, you have a single professional working at HSBC. They want to pay £1,300 a month, and it's up to you to say yes or no. But that will all be facilitated through Joseph Mews and our partners on the ground. So the rental side, that's for long-term let. But again, for the developments that allow short-term rentals, we also have partners that we introduce you to for that as well. And we'll always advise you what's going to work best for the development that you've bought into. So again, you're in good hands there.
Yeah, question from George. I was advised that as a foreigner, if we set up a local company and purchase an apartment or property as an investor, then we are not taxed. Is this true? Unfortunately, yeah, you are taxed on that, and we've got specialist partners that we work with, but you can mitigate. So you can you have an allowance in the UK if you haven't got any other property, so you can earn £12,000 a year before you get taxed on that. You can help with, if you set it up in a company, when you sell it on the income and person isn't paying stamp duty. It can help with things like capital gains. So everyone's situation, obviously, depending on the jurisdiction and your personal circumstances, is slightly different. But we have partners and people that we work with that can give specialist advice for your particular set of circumstances. So
yeah,
yes.
For George, again, it's asked the question on the tax on the rental. It's important to remember, again, we're not tax advisors, so we have partners that we're to introduce you to on this. But generically, as Andrew said, if you're overseas, or depending on what passport you hold, but the majority of countries in the world have a double taxation agreement with the UK, which means that you get this free allowance of around £12,545, I think it is at the moment. So if you're living in the UK, like Andrew's clients are, and you're already earning a salary, and your rental income is going to top up that salary, you're going to be paying the highest bracket, tax bracket, right? So it doesn't make sense. So then it would make more sense to buy through a limited company where you're paying corporation tax, which is 19%. If you're overseas, so as my example, as an overseas resident, I don't have any other income in the UK other than my rental property. So I have that £12,400 free. So I'm in a low bracket here. I don't pay any tax on the initial property. And up to, typically we say 3 to 5 properties, if you're not earning any other money in the UK at this price point and these rental values, it makes more sense to buy it in your own name than it does through a business. So the actual tax that you pay on rental income, if you owned one property in Settle in Birmingham, you had no other income in the UK, you're not going to pay any tax on that. So that's important to remember. And again, as I say, it's important to speak to a tax advisor on your own personal circumstances. The capital gains tax, I think, is one that we've got a question about, and is one to always mention, is the fact that capital gains seems like a very daunting tax, and it is. Of course it is. It's a tax, and every tax is relatively daunting. But one thing to remember is that the capital gains tax is obviously a tax on the gain, right? So you buy a property for £200,000, you sell it for £300,000, you're liable to pay tax on 100,000, right? That's your gain. However, you can deduct every single cost, including stamp duty, from that 100,000. So from that 100,000, you reduce from the stamp duty, all the costs that you've paid on management and the things you've had to fix in the apartment. Every single penny that you've attributed to that property is deductible. So when you whittle it down, you sell a £300,000 property, but you might only be paying tax on £60,000. So it's not on the total, and that's important. The UK is the most invested market in the world, and it has been historically. Why? Because people make the most money from it. If capital gains was such a deterrent from people making returns, then people wouldn't be doing it. So it's important to remember all the facts. But again, it's good to speak to a tax advisor from your own personal circumstances to understand what the implications are.
I've got a question here. It says, I made several comparisons like bad off plan and ready made, but he didn't say which was better or preferable. Well, we do both, and it kind of, we've got stuff coming up to completion. So it depends. Some people say, no, I want an immediate rental yield. Some people say, and if it's ready now, you're getting mortgages at today's rate. Some people say, no, I want off plans, because as we saw from Sophia, we expect mortgage rates to drop. So you maybe want to reserve now. You put typically down at 10, as we saw, or 20% deposit. And when you come to completion, you've got better mortgage rates. So it really depends on personal choice. I like off plan because, as I say, if you wanted to buy that award-winning development Lockside Wharf and you waited till it was completed, it's too late. It's sold out. We might have people flipping and selling on just to make money there. So it really depends on your own sort of personal circumstances and requirements, really. And as I say, if you look at buy-to-let mortgage and you're going now, you're going to need sort of about 25% of the purchase price to be able to go on. Another question. Sorry, go on, Johnny.
No, I was going to read one. How much do you need to start? It's a good question. Look, it depends, I guess. We talked about the Manchester development there, where it's a 10% deposit. So you're looking at 20 odd thousand pounds there to put down, but then you're going to need another 20,000 to put down in 6 months' time. And then obviously, whatever you're not mortgaging, you've got to remember the costs at the end. You're going to pay, let's say on a 70% mortgage, you're going to pay another 10% on completion in 2025. And that's when you're going to pay stamp duty and your legal costs. So it's always good. Again, these cash flows show you every single penny you're going to need. So you can, prepare for the worst, which is always better to not put yourself under too much pressure. But again, buying in an off-plan property, as Andrew just said, it gives you the flexibility of more time to save. You have another 18 months to save another 10% for an example for that. So, but again, to answer that question, if you were buying something today that is ready today and you wanted a 70% mortgage, looking at the Derby project there, you're probably going to need around, say, 50 to 60,000 pounds, really. But then if you're buying off plan, obviously that can be staggered and broken down a little bit more.
And then we've got another question. Does it make a difference if I go into this solo or jointly? So no, you can do that. You can have, you can buy in your own name. You can buy in a joint name. You can buy in a company name. So yeah, no problem at all. Got another question on service accommodation. Yeah, I sort of touched on it in the presentation. Appreciate we cover a lot of points, but if the developer allows it, you can do short-term lets, otherwise known as serviced accommodation. And as I say, we do partner with a couple of serviced accommodation partners that allow it, because there's health and safety issues, there's insurance issues, and we want to protect the integrity of the development as well. So we tend to do the more sort of what I call corporate short-term lets rather than your leisure Airbnb, and it's more profitable to do that as well. So yeah, we do serviced accommodation. Do you want to take that one from George there?
We've done that one already.
Sorry. What the return one? Did we do that? Sorry, miles away.
I think we've done most of them now, haven't we?
I think so. Please clarify what you mean by off-plan. So off-plan means it's not ready yet. It's got all the planning, approvals, permissions, everything in place. Construction may have just started or is about to start. So you're waiting for it to be built. And if you're getting in early, it's an 18-month, up to an 18-month window. We put normally 20% down up front, 80% on completion, and an element, a large element of that can be mortgaged. Have you got the was another slide, have we, just if anyone wants to book in a session with either myself, we look after different regions, Johnny or Mark, so we can we've got a half an hour slot that you can book with us. Is that bookable on the next slide, Sanjana?
We have one for referring.
Yeah, so we've got a referral there. So you can, if you've got anyone you refer to us and they purchase from us on exchange, there's £1,000 for referral there. And then I think we've got another slide where we can do the There we go. So if you'd like to book a referral with us or refer someone, so if you can tick one of those top two boxes, if you're interested, and the relevant member of the team will get back to you, and spend half an hour or so just going through this in more detail on a one-to-one basis. And then again, we're going to do a webinar a month. So there's another box there, box 2, if you want to tick that, to have a look at what you might like to see covered in future webinars, because we want to make it educational and informative. So we're happy to take on any of those topics below. So if you can tick the box there, that would be brilliant. Or boxes.
Perfect. Well, guys, thank you for everyone that stayed on. Obviously, it's been an hour and a half, which is great to see so many people still listening to us. So hopefully you're there. But yeah, just to say a massive thank you, obviously to Liam from Knight Frank, to Sophia from Madewell, and obviously to Andrew and to Sanjana for setting it all up. So you'll be sent everything on an email. Obviously, you've got the option there to book anything in. Any questions, any suggestions? Obviously, feedback is great for us. We, at the end of the day, we do these to be as informative and as helpful as we can. So, you know, if there's any ideas or things you want us to cover on next month, then just ask. But yeah, thank you everybody for your time, and see you at the end of February.